Morning, everyone, and thank you very much for joining me. This is the Morning Market Review. My name is Russell. I'm a Senior Market Specialist at FXCM, and my email address rshaw@fxcm.com. Today is Thursday, the 21st July 2022. Just going to bring up our high-risk investment warning. Just want to remind everyone I'm going to take next week off, so I'm going to cancel the webinars for next week. So if you don't get the reminder in your inbox, don't worry about it. We'll resume the week after. So just want to give you some notice there. And I'm just going to bring up our market commentaries disclaimer. I'll keep this on screen for a few moments as well. Just incidentally, while I'm away, there is going to be the FOMC meeting. So just be aware of that. That's on Wednesday. We're going to get the Fed funds rate, probably get about 75 basis points there. But just be very cognizant of the communication that comes out, and we'll discuss it when I get back. Hey Rob, nice to have you back, and congrats. Very, very nice. So his eldest daughter's just graduated. Very, very cool. All right, here's our references. Market Scope, we'll do CNBC, Trading View. I just wanted to bring in Forex Factory today as well, because of course it's the ECB is coming, and the market is expecting 25 basis points. There's a report of 50 basis points. I'll be hugely surprised if they come in with 50 basis points. I think that whilst I would understand the 50 basis points, I think politics around Europe might preclude such a aggressive hike. Of course, never say never. And there is some talk about introducing a tool specifically to deal with the different factions within the ECB, etc. I would expect that that tool gets sort of released before the aggressive rate hikes. Nevertheless, there is a certain amount of risk here. There's uncertainty. We're going to look at Euro, US dollar in more detail a little in a few moments. I expect 25 basis points. Nevertheless, what I really wanted to show you on this calendar is that the times have changed. I think that the main refinancing rate was released at 45 minutes past the hour. I think it's come down to 15 minutes past. And so I think there's slight changes in the times here. So just be aware that you know these times. This is in my local time, which would be 1:15 UK. Okay, 1:45 UK. So expect the volatility there. All right, so we just needed to introduce that. I want to talk about this in a moment. This is the 2-year yields of the German 2-year versus the US, stochastic of the spread between the two notes, and then Euro US dollar underneath. I think we just want to keep an eye on this, given the fact that the ECB is going to start raising rates. And with that all said, let's go ahead and go through the CNBC article. The headline reads as follows: European markets head for lower open, anticipating first ECB rate hike in over a decade. European stocks are expected to open lower on Thursday, with the region's investors geared up for the European Central Bank's latest monetary policy decision, in which it's widely expected to announce its first interest rate hike in years. The European Central Bank's policy meeting in Frankfurt on Thursday is at the forefront of investors' minds, with policymakers having given advanced notice of the first hike in 11 years. Still, this comes against a backdrop of slowing growth, the war in Ukraine, and threats to energy supplies. The ECB will publish its monetary policy decision after the meeting of the Central Bank's Governing Council. Press conference will be held at 2:45, and this is Central European Standard Time, CEST. I think it's Central European Standard Time, with ECB President Christine Lagarde. In June, the central bank said it intends to raise the key ECB interest rates by 25 basis points at today's meeting. It has been plunged into fresh political turmoil, with Prime Minister Mario Draghi expected to tender his resignation Thursday after a number of parties in the governing coalition abstained from a vote of confidence that was aimed at renewing and reuniting the fractious alliance. Draghi won the vote but many senators refused to take part, bringing the National Unity government to the brink of collapse. Early elections could now take place in September or October. Price rises continue to overshadow the region. On Wednesday, data out of the UK showed inflation hitting another new 40-year high in June as food and energy prices continue to soar, escalating the country's historic cost of living crisis. Earnings on Thursday come from Roche, ABB, SAP, and Anglo American. Okay. So I think that let's actually start probably with the US dollar. It's probably a good place to start. Okay, so it's becoming more difficult, in my estimate, to analyze Forex. And the reason for that is because this has been some sort of movement away from the Fed being absolutely dominant in terms of aggression in their monetary policy. We've now seen the Bank of Canada raised by 100 basis points last week. That was a surprise. We've seen European Central Bank starting to raise, first time in 11 years. So we're moving away from sort of an absolute type of analysis to a relative type of analysis. We've always looked at things on a relative basis. We've had to, because currencies are relative to one another. A currency by itself is meaningless. You're always measuring one currency against another, but it's been relatively easy because of the dominance by the Fed. And it's not only the dominance by the Fed that has influenced the dollar. There's also been a general sentiment of the dollar being the safe haven. So we've had a certain amount of market turmoil, and well, the logical place to put your money, dollar. So you've kind of got these two variables moving in a similar direction, being dollar positive. It's got a little bit more difficult because there's questions now. Have we bottomed? We don't know. What's going to happen now that the other central banks have started their monetary policy and are pushing aggressively, right? So if we go through to the dollar on a weekly basis, one sort of point to make is that, of course, the dollar needs some sort of respite. It needs to pull back. We're overbought on the dollar. So the dollar weakness here on a technical basis, not surprising given where this RSI is. This RSI has been in excess. So the normalization makes sense. Again, the timing of the normalization on a weekly chart's never easy to tell, because it's a weekly time frame. It may stay overbought or oversold, depending on the instrument, for a fair amount of time, before a few weeks, right? A few months before the correction happens. Well, it looks as if the correction, we're sort of in the midst of a correction. So technically speaking, it makes sense. But now we've got to try and make sense of it in terms of the fundamentals and try and marry the two disciplines. So the question is, of course, if the fundamentals have shifted to the point where the relative strength of the Fed comes into question, and there is now a question of whether the safe haven is truly sought after, because there could be an argument to be made that money is now being rotated into perceived value in the stock markets, in the risk side. My opinion, okay, and I'm going to tag on that subject to correction, is that I think it's too early to call a top in the dollar. Again, not to say that the top hasn't been reached. It's most certainly is a possibility. However, I need to see more evidence. To me, this looks more like a technical correction. And then whenever there's a technical correction, the narrative that is spun out of the media needs to kind of match up with the technical correction. So have we bottomed? We may have, but we may not have either. Okay, so there's still a big question mark there. The likelihood that other central banks can realistically compete against the Fed, in my opinion, is also overblown. I'm going to tag on that subject to correction, but the big X factor here, the big X factor that needs to be considered in these kind of analyses is the runoff of the balance sheet. That is, in my opinion, a huge influence, because it's taking dollars out of the market at a pace that simply cannot be matched by any other central bank out there. And that being the case, it's early to call a dollar top. Now, how will we know if there's a dollar top? Well, we won't know until after the fact. Very much a continuation of yesterday's webinar. So something where we have a movement down. So at the moment, it still looks corrective, because this would be another higher trough. Where would the first crack in the armor appear would be if it fails to take out current peak. Because now we've got to ask ourselves, what's preventing the market? What's preventing the market from effectively taking out the peak, right? And that would be based on fundamental reasons. And then, of course, if it moves as such, well, now we've got something meaningful. Now we've got something meaningful where it is, there's little doubt for our interpretation. Here we would have a lower peak followed by the lower trough. That would be, I think, suggesting dollar top. What's this in terms of pattern? It's a head and shoulders. That's why head and shoulders tops are so, I guess, well known. It's because they really, the transition from uptrend to downtrend, head and shoulders bottom, transition from downtrend to uptrend, has to be because of the peak and trough analysis. So this, to me, would be suggestive of, wait a second, fundamentals have changed. Because fundamentals have changed, technicals must change. But to call a dollar top now, in my opinion, is premature. Yes, we are correcting. Guess what? We needed to correct. Why? We're overbought. Okay, so the idea here of dollar top, in my opinion, premature. How does that help us as traders? I think it helps us tremendously, because now let's just bring up Euro here, and then we're going to go through to trading view. Okay, in that, well, we've got the downtrend here. How will we know when Euro has bottomed? It's very, very similar to what we've just described. Sorry, my system's just slowed down because the cash markets just opened in Europe. Just give me a moment. Incidentally, you can see how the overbought condition in the dollar lines up very closely with the, we didn't go quite as oversold in the euro, but we did hit that 20 and possibly just below it. Bang on the same time as the RSI peaked for the US dollar, and that makes sense. Why does it make sense? Because you're essentially looking at, on one hand, you're looking at the US dollar as a numerator. Next chart, you're looking at it as a denominator. So the matchup here is not all that surprising. But how do we measure the bottom here? It comes down to definition. I think that if we just keep working to definition, it's going to help in a very confusing environment. But we've got to make peace with one factor here, is that we're just going to be late. We've got to make peace with that. We're not going to be able to pick the bottom, and we're not going to be able to pick the top unless, you know, we're consistently calling the bottom. Eventually, sometimes we're going to be right. In other words, somebody may have said, well, this is the bottom. Well, it turned out to be wrong. Somebody could have said, well, this could be in the bottom. Well, it turned out to be wrong. The same person could say, well, this turns out to be the bottom. Who knows? Maybe this time they're right, you know? So you carry on calling the bottom. At some stage, you're going to be right. I don't think that's the way we approach it. I think we have very clear definitions. We know what an uptrend is. An uptrend has a very distinct definition: higher trough followed by higher peak. Downtrend, lower peak followed by lower trough. Where do these definitions come from? They come from Charles Dow. These have stood the test for over 100 years. So the idea here is we'll never get the bottom. We'll never get the top. We've got to be okay with that. But we continue to test for it. Okay? We continue to test for it. The bottom, let's bring back, this gets validated, this point gets validated when this peak gets taken out. Then we've got the validation. Now let's bring in some fundamentals here just to help us with this discussion. So we're going to bring up trading view, and this, I think, is a very good chart for us to keep on top of as well. So now we are looking at this in terms of central bank aggressiveness. How so? Well, we've got here the 2-year for Germany. I'm using that as a proxy for Europe as a whole. And we've got the 2-year here for the US, and we've just subtracted one from there. We're finding the difference. That's the spread. And the reason we're taking the 2 years, because monetary policy, central banks tend to move the front end of the curve. The only way that they would move sort of the the barely or the longer term, that's called quantitative easing or quantitative tightening. Okay, but the true sort of monetary policy mechanism, the one that's kind of the traditional tool, that's the front end. Okay, so that's why we're looking at the 2-year versus the 2-year here, and we've got something quite remarkable going on. Let's bring it in here from this point. Now, the reason I've gone back to July 2021, I mean, we can go back further, but let's go through to July 2021. And the reason we're going is that's when the stochastic drops below 20. That's when the stochastic drops below 20. And then ever since then, you can see the spread really worsens for the I don't know if worsens the right word. Let's just say the spread favors the US side. Okay, so the spread moves towards the southeast. Well, that means that the spread, okay, is favoring the US too. Now, that's coincided with the momentum. So the momentum to the downside is very much a function of the interaction between the spreads, which is very much a function of how the market perceives the implementation of the central bank monetary policy. Drop down to the last chart, and here's the euro US dollar. So if you take a look at the if you take a look just between the strong downwards momentum of the spreads, well, that's really when the euro US dollar capitulated from let's call it 119, all the way down to 103, roughly, just sort of rounding off. So there's a huge capitulation here in the euro US dollar. Now, what happens is, if we take a look on the 16th of May, we've got the stochastic actually coming out of 80. It actually sort of pops out around about the 23rd of May. Okay. Now the obvious question is, well, what happened on the 23rd of May? What's pushing the spread up? And as far as I can tell, this is the period when President Lagarde released her blog post where she outlined the path for European central bank policy normalization, and it was a very strongly written piece, clearly outlining the intentions of the European Central Bank. It was very hawkish, and of course the spread bumps up here. So we see the spread bump up here. The momentum favors the bump up. This little red rectangle here, that's the euro stabilizing, okay, for a very brief period. It only stabilizes till about there, right? And then we have Fed just taking over, and the Fed takes over, spread resumes. Take a look at the stochastic, pushes downwards. We're on the cusp of going back under 20, and then the idea is, if we go under 20 and if we maintain, then the spread between the 2-year notes carries on moving in that southeasterly direction, and I would expect that brings euro US dollar down with it. There's a lot of assumptions in that analysis. The first assumption is, of course, that the market does recognize a dominance by Fed over ECB. I'm actually comfortable with that. Where it maybe breaks down is, well, what about the dollar as a safe haven? What happens if the need for a safe haven is done and dusted? What happens if we have bottomed? So then the analysis is going to break down a little bit. And again, we would need to wait for those peaks and troughs just to give us a little bit more direction. So from that point of view, I think so we've got two variables we're looking at. We're looking at relative analysis on central bank side. What about the safe haven? Okay, so from the central bank relative analysis, it very much depends on stochastic. Okay, do we drop under 20 and maintain? And I think that's going to tell us all the information we need to know in terms of which central bank is having the more influence. If it kind of moves up here, well, then clearly ECB has started to dominate, and we're going to have to change, or I'm going to have to change my approach. The second part, the breakdown, what about is the need for the safe haven over? And again, let's go now and do an analysis of the risk markets. So I think that there certainly is a case to be made that we could have bottomed, but there's a case to be made, of course, that we haven't bottomed. And the case that we haven't bottomed, in my opinion, is the clearer case for now. Why? On a technical basis, we've got a potential lower peak being charted. I could be wrong. How will I be wrong? Only in hindsight. Unfortunately, there's a lag. I would have to change my thinking very quickly once I get this higher trough followed by the higher peak, because if I don't change my thinking, then I'm losing out on huge potential, right? But at the moment, we don't have that. We've got the possibility of lower peak. And if this does turn out to be a lower peak, well, then the variable of safe haven is still very much in play. Okay, where I think this becomes a very interesting analysis actually is when we take a look at the Dow Jones. So this is going to be super interesting just over the next week, and we'll have to talk about this on the Monday I get back. But if we go through to the US 30, okay, and I want to look at this on a weekly basis. Now, this over here is obviously, it's a very strong looking candlestick that we have for this week in the midst of Netflix, Tesla. You know, Netflix. What happened with Netflix? They lost 1 million. They lost 1 million subscribers. I just see a breaking headline here. Italian Prime Minister says he will resign after reviving coalition. So I think we kind of covered that. All right. So they lost 1 million subscribers, but the market had priced in 2 million, right? So the obvious question is, well, why are they bouncing if they've lost 1 million subscribers? Is because they were priced to lose 2 million. See, there's that forward pricing that we're talking about. Okay. So what we want to see here now, this is really interesting as a technical analyst. What we're about to discuss here, in my opinion, really interesting. The current failure point for this current so the current failure point for this leg here, in my opinion, is the black horizontal. How come? Because this candle here hasn't completed. I'm putting an error. This candle here hasn't completed. It's only going to complete tomorrow. So because it hasn't completed, we don't really know where this candle's close price is. I mean, to be quite honest with you, it's going to be really unrealistic to suggest that we're going to close below this current measure. I mean, that would be a huge sell-off, which just, in my opinion, you know, just not going to happen. But so the fact that this is still the live candle puts last week's low as the failure point, which is quite, so there's a big gap between the current close and the failure point. What subsequently happens now is that the lower peak actually becomes more probable with a positive close this week. Let me show you what I'm talking about. I feel like I'm not being too clear here, but if we close, let's assume that this candle is the close. Let's say this is a closed candle. It's now the weekend, and we are trying to assess how would we get this lower peak. Well, it comes back down to our reference candle analysis. Okay, so let's just put in our reference candles here. So there's three points to note with a reference candle analysis. The first point would be we need to find the highest high in at least 3 candles. Okay. The second point would be price dropping below that reference candle's low. But until we actually get a close below that reference candle, we don't have the actual reversal locked in. So now let's apply that thinking to the current Dow. So this would be kind of the current condition 1, and price dropping below this black horizontal, in my opinion, would potentially be the third condition. What subsequently happened with the price action this week is that this now becomes the reference candle. And if this is the reference candle, then next week's candle, if we get a lower low and a lower high and we close below this red, then we potentially have this lower peak locked in. If we have the lower peak locked in, that's a bear market rally, or that's a potential bear market rally. That's a lot of pain right there. So how do we avoid this? Obviously, the way to avoid this would be, there's two ways. Price takes out the previous lower peak, because then we can't have a lower peak anymore. Then we've got the higher peak. So that if price is strong enough and takes out this lower peak here, then the bear market rally scenario evaporates. The other way that it would disappear would be if we make the higher trough higher peak. Then it disappears. So at the moment, it looks to me as if we're getting a potential lower peak in here, but it's a question mark there. I can't say for certain, right? And the reason that I say that it looks like it's a lower peak question mark is because a trend, is a trend until it isn't. So we've got a lower peak, lower trough, lower peak, lower trough. If prices don't move in a straight line, if this lower peak, if this trend is set to continue, well, it makes sense. It's going to zigzag. Well, we could be kind of in the middle of a zig, right? Waiting for the next zag. So this now becomes exceptionally interesting as a technical analyst. How do we factor fundamentals in here? Well, we're in the midst of earnings season, so that's the one factor we have to keep on top of. Earnings always are going to influence prices. And then the other way we can keep an eye on this, I think, is to keep an eye on the real rates. So if we just drop this off, and we go through to our real rates here, so we go US 10-year minus break even. Okay, so let's just pop this in. All right, and let's put this on a daily. All right, and this now to me is very important. This chart to me is, again, not getting the attention it needs. This looks like in technical analysis, this looks like a flag. What's a flag? Flag's a continuation pattern. If it is a flag, it should then continue in the previous direction. Okay. In other words, there should be some sort of pop here. What does that mean in terms of the stock market? It means everything. It means everything. Okay. It comes back down to our time value of money. And the time value of money is, again, there is obviously complexities to it, but we just, for our purposes, we just need to know the very basic sort of cash flow, 1 plus, let's call it real rate. Okay, we're not even going to put in a to the power. We're not even going to put that in. All we're going to look at is what's happening to this guy. What's happening to this guy? Is that guy moving up or down? So we'll assume a constant cash flow, although it's probably not. That's not wise. This cash flow. So let's just say earnings comes out and dividends have been raised. So that would affect the numerator. But generally payout ratios are constant. So assuming a constant over here, I don't think is too far-fetched. But this real rate, that's in flux every single day. And not only is it in flux, it looks as if it's about to break upwards. So if it's about to break upwards, okay, that means there is a fundamental concern in terms of our bear market rally scenario. Does everyone understand that? But it's very important. So think about it like this. Well, I'm going to just do it very, very simple. We're going to put 1/2 equals, okay, 1 over 2, we all know equals 0.5. Have I written that properly? Okay, where 1 represents the cash flow, 2 represents the 1 plus the real rate. Now, we can see that the real rate looks to be moving up. It hasn't broken out yet. We know that 1 divided by 2 is giving us a present value of 0.5, according to this very sort of simplified example. Let's say the real interest rate increases so that now we've got 1 divided by 4. Okay, well, that's going to give us 0.75. What am I talking about? It's going to give us 0.25. I'm begging your pardon. Got to get my coffee in. Okay, all right. So you can see, well, what's happened? So the numerator increases from 2 to 4. What's happened to our present value? Our present value has dropped from 0.5 to 0.25. But that's the bear market scenario. So this here, I think, cannot be ignored. We break out here, okay? Then next week's analysis becomes really interesting in terms of time value money mechanics. And I think the saving grace would be earnings. That would be the numerator side. That would be the cash flow side, right? So we'll just have to keep an eye on that. So the technicals here, just to kind of look interesting. The fundamentals here look interesting. And then the relative analysis from the bank side look interesting. We're in a very difficult market because of all this kind of moving parts we have to keep our eye on. But let us assume that this is a bear market rally. Let us assume it is, okay? And it plays out that we're going to get another lower trough. Well, that means there's a lot of pain, but it also means there's a lot of opportunity. If somebody's exploiting to the short side, a lot of opportunity there. And that for us is kind of where it gets even more interesting. So that's what I am looking at. Euro US dollar for me, just to end off, is a huge instrument on my watch list. I'm really wanting to get in on this. I kind of saw the short here. Fortunately, I had to exit. Okay, I'm not getting. I didn't get the swing that I wanted, but I'm looking to see if we get another opportunity short here, and I would consider taking it. One issue, I would only put that trade on after ECB, so that ECB could ruin the whole scenario, because either there's a huge drop and then I've missed, or there's a huge movement up and the fundamentals have changed and I've got to reevaluate. But this is kind of what I'm looking for on my watch list. All right, I think we can conclude at that point. If there's any questions, please go ahead and type those in. So tomorrow we will have a webinar, but from next week, just reminder, I'm going to take next week off, and then I'll be back the following Monday. All right, guys. If anybody needs to contact me, you've got my email address. Thank you very much for signing in this morning. Much appreciated, as always.